So early in May, we found out that Warren Buffett had sold all of his airline shares. Some investors were quick to point out that this was just an indication of how Buffett views the airline industry, not his thoughts on the overall stock market. However, since then, Buffett has sold 84% of his stake in Goldman Sachs and has grown his cash pile to nearly $140 billion. In times like these, I find it best to look past the words and analyse the actions of great investors such as Warren Buffett. If we can successfully analyse what one of the world's great investors is doing with his money and why he's doing it, maybe we can learn a thing or two, which would help us with our own investments during these somewhat crazy times. That's why in this video we'll be taking a look at Warren Buffett's recent actions. We'll be explaining why he isn't buying stocks using things like the Buffett ratio, and most importantly, what this means for us and how we can learn from him for our investments. So let's get straight into it. In the first quarter of 2020, Berkshire Hathaway posted a huge net loss of nearly $50 billion. With the stock market suffering from a major crash, this wasn't exactly a surprise though. What is a surprise is Buffett's actions afterwards. As Buffett has famously said in the past, be greedy only when others are fearful. In other words, when the stock market is crashing and everyone is fearful that it will fall further, this is the smart investor's opportunity to buy stocks at a discount. Imagine the stock market as your favorite clothes store. This top, for example, I think is from Next. If I walked into a Next store, when they do eventually reopen, and found this same top at a 30% discount, that would be great. I'd probably buy quite a few. So why should the stock market be different? If there is a stock you love and it drops by 30%, it's an opportunity to buy the same item for 30% less than it was a few days before. This is usually when Warren Buffett goes shopping. In 2008, when the market was in a frenzy and most investors were fearful, Buffett swooped in to pick up $5 billion worth of stock in Goldman Sachs and made a tidy profit from it. So when the stock market crashed in the first quarter of this year, you'd expect Buffett would be up to his old tricks and begin shopping while the sale was on. However, he did the opposite. He actually sold more stocks than he bought. Not only did he sell all of his airline shares, he also sold 84% of his stake in the bank Goldman Sachs. He sold some of his position in another bank, JP Morgan, although this was a smaller portion with just about 3%. On top of this though, he reduced his investment into Amazon by 0.7% and sold his entire stake in Phillips 66. For an investor who so frequently highlights the importance of holding stocks in the long term and ignoring the short-term fluctuations, Buffett has been making drastic changes to his company's portfolio. So the question is, why? Because Warren Buffett believes we're in a recession. Okay, I think we're finished. That was a quick recording today. Thanks for tuning in. I'll see you again soon. Okay, no, but seriously, let's take a look into what Warren Buffett is thinking and how we can learn from his wealth of knowledge for our own personal investing. So as I mentioned at the beginning, we can use something known as the Buffett ratio. And we're going to talk about that in just a second. But quickly, I'd like to say this video took a long time to research and even longer to record. Believe it or not, I'm actually on my 17th minute of recording so far, as I'm really not very good on camera. So if you could take a second to like the video, it helps the YouTube algorithm and I would really appreciate it. So let's look at the Buffett ratio. On the screen now, we can see this chart. And that the current level of 156% is near all-time highs. But what does this mean? What exactly is this chart telling us? Well, this chart is a ratio of the value of the stock market divided by the GDP of the United States. Or in other words, it is the value of the stock market divided by the size of the economy. So you've probably heard that the stock market isn't the same as the economy. In fact, if you've taken a look out of the window over the past few months and then noticed that the stock market is somehow still rising, I'm sure you know exactly what I'm talking about. But here's the thing. The Buffett ratio puts the stock market in context with the economy because Warren Buffett knows that while the stock market and economy sometimes head off in different directions for a while, they will nearly always meet again further down the line. If the stock market grows, but the economy doesn't, the Buffett ratio grows higher. If the ratio increases too much, a rational mind would expect the stock market is likely to drop at some point. Although, then again, a rational mind can hardly account for Jerome Powell and the money printing machine. So, there is that. But what we have to remember here is that Buffett is a value investor, which means that he invests into stocks that he believes are below their fundamental value. With the entire stock market appearing high in relation to the economy, it's likely that Buffett can't see many, if any, stocks that are trading below their fundamental value, and as a result, a second crash could be around the corner. Here's another indicator. This chart shows the PE ratio of companies in the stock market, dating back to 1880. If you haven't heard of the PE ratio, don't worry, it's not complicated. It's basically just a measure of how much a company is worth compared with how much money they actually make. The higher the ratio, the more expensive you could say a company is. This kind of makes conceptual sense, right? If you have two companies, let's say, Company A and Company B, and Company A makes twice as much money as Company B, then Company A should be worth more. In other words, a company that makes more money should of course be worth more money. But here's where it gets tricky. When times are good and investors are optimistic about the future, people begin to pile their savings into the stock market. This causes the market to rise, but it doesn't mean that the companies are actually making any more money than they were before. All that's happening is their stock price is growing, but the business itself might not be. Or the business might be growing as well, but not as quickly as the stock price. And this is what we can see on the chart from around 2009 onwards. From this point, the PE ratio of the stock market is regularly growing, and that means that the stock prices are growing fast. But the companies aren't actually earning that much more money. As an investor who is looking for stocks trading under their fundamental value, this is of course a bad sign. Look at 2008. The ratio dropped to 15, the lowest it had been in nearly 20 years. Perhaps Buffett looked at this and thought to himself, the companies look relatively cheap. Because he believed that the number would rise again, he was investing heavily. Compare this to today and the ratio is just under 30, which tells us that stocks are now twice as expensive compared to their earnings than they were in 2009. And higher than the vast majority of the past 140 years. And this is taking the recent crash into account. So if we're talking about trying to find undervalued stocks, again, this isn't the best sign. However, I don't want to only highlight arguments for why the stock market is overvalued. I want to approach my research from an unbiased perspective. So let's look at another chart. This time it's a bit more positive, and it's going to show that the stock market, in fact, could be undervalued. On the screen, you can see what is known as the Brock value. Do you remember from earlier how the Buffett ratio looked at the stock market compared to the economy? Well, the Brock value does the same, except it also includes the country's interest rate. So it has the economy, the stock market, and the interest rate. Why include the interest rate? Well, as Buffett says, the most important item over time in valuation is obviously interest rates. If interest rates are destined to be at low levels, it makes any stream of earnings from investments worth more money. In other words, without getting too technical, a lower interest rate usually results in a higher stock market, and a higher interest rate usually results in a lower stock market. Now let's consider that interest rates are near all-time lows, and there are many calls for negative rates in the upcoming future. When we factor this in, the Brock value begins to tell a very different story. In fact, based on this chart, the stock market was overvalued for most of 2018 and early 2019. But around mid-2019 this flipped. As the yellow line, which represents the stock market, drops below the white line halfway through 2019, this indicates that the stock market is actually undervalued. From here onwards, we can see the stock market has been undervalued ever since, and is quite significantly undervalued at the time I'm recording this. So what is it? Is the stock market undervalued or is it overvalued? Make your mind up, Tom. Well, in my opinion, it's probably more likely to be overvalued, based on what I'm seeing. Much more impactful than just my thoughts, though, is looking at what the world's top investors are doing. If you're subscribed, you'll know how I regularly talk about my two favourite investors, Warren Buffett and Ray Dalio. Warren Buffett is selling more stocks than he's bought, and his company is sitting on the biggest pile of cash they've ever held. So he doesn't sound too bullish. Ray Dalio has been boldly saying we are in a depression like the 1930s, so it's fair to say he's not too bullish either. So why did I show you that last indicator, the Brock value? Is it just to confuse you more? Well, the truth is, nobody knows which way the stock market is going to move. Not even the world's best investors, and certainly not me. So while it would be easy for me to say that the stock market may crash again, I have to recognize that I'm certainly not smart enough to make such bold predictions. Instead, the best thing I can do to add value to you is to highlight the likelihood of both outcomes, so you can understand why it's important for investors to prepare for both outcomes. I know that may sound somewhat counterintuitive, right? How can you prepare for the stock market to rise and prepare for it to crash at the same time? Surely you have to pick either direction. Well, if you are 100% invested into the market, you're screwed if there is a crash. If you're not invested into the stock market at all, you risk missing out if the market continues rising. Now, I'm not a financial advisor, and I'm not going to tell you what to do. My only aim with these regular videos I record is to share my research as I try to wrap my own head around things. And all I'll say is that from my research, hedging your bets often looks like a good idea. In other words, not being all in or all out. The key to this is to make sure you do a few things well. If I were to ask you, what are you invested into? What would the answer be? Would it be mostly the American stock market? Perhaps an S&P 500 index? If the answer is yes, I understand. That makes total sense. Over the past 100 years, that's basically the best investment around, and I expect it will be one of the best investments again over the next 100 years. But consider this for a second. You're well diversified across the American stock market. Doesn't it make more sense to diversify across different countries and different investment types? So, not just America and not just stocks. You see, most people have a tendency to invest into their own stock market far more than they should. Take me, for example. I'm from England, so should I invest more into the English markets than the American? Well, no, of course not. Just because I'm from England, it doesn't change anything. America is the world's largest economy and the world's largest stock market, so it makes more sense for someone like me to invest more into America than my own country. This is why I talk so often about the American markets and not as much about the English. The best thing you can do is to pretend for a second that you're not from any country. Imagine you were an alien who visited and decided you wanted to be the next Warren Buffett. Okay, slightly strange, I know, but just go with me here. If this were the case, you wouldn't be affiliated with any country. So you'd look at all of them and conclude that it doesn't make sense to invest into only one. Instead, you might buy a little bit of each of the countries, and you'd probably buy a little bit more of the countries with the larger economies, such as the United States, and you'd probably also buy a little bit less of the smaller economies, such as England. So, if you're holding the American stock market, ask yourself how well diversified that really is. Does it make sense to add some of the UK stock market? What about the rest of Europe? And how about the Asian markets? Again, try for a second to pretend that you're not from any country and simply ask yourself, what would you do in that situation? Because we all fall foul to this tendency to invest into our own stock market. But the truth is, if you're building the perfect portfolio, why does it matter what country you're from? Surely it's a numbers-based thing. So really, dividing this up between the biggest countries, regardless of where you're from, seems like the best thing to do. After you, as this alien, has invested into many different stock markets, you realize that you're still not diversified because you only hold stocks. Yes, you do hold stocks in many different countries, but as we know from past experience, when the stock market crashes in one country, it often crashes in another one too. So are you really prepared for a stock market crash? This is when you might want to think about diversifying across different investment types. In particular, investments which don't go down when the stock market does. Holding a little bit of these investments as well as stocks might protect you better if a crash does come. In fact, I've recently released a video discussing two of these types of investments and how the world's best investors are investing into them right now to protect themselves in case there is a crash. So it should be up here now, and if you want to check it out, click up here. If you've enjoyed this video, well, I release 3 videos per week like this on Mondays, Wednesdays, and Fridays. So be sure to subscribe if you don't want to miss them. Thank you for watching.